I'm James Turk. I'm a director of the Gold Money Foundation, and I'm here in Munich, Germany with Eric Sprott, founder and chairman of Sprott Asset Management in Toronto, Canada. Now, Eric, we're here at the Edelmetall Messe conference in Munich, which is one of the largest gold and silver and mining conferences in Europe. What are your impressions of this conference?
Well, as I mentioned in my speech, I'm very impressed by what's happening here. I think the thing that most impresses me as a North American who's attended his first conference where we actually transact business in precious metals, I am shocked at the level of activity in terms of people buying substantial quantities of gold and silver coins. I'm most impressed by it. And there's so many vendors here. So it's been a great conference. It's probably one of the best attended conferences I've ever been at. I think they say there's 7,000 people here, so it's been quite encouraging to come here, and thank you for the recommendation of coming here, by the way. And I think it's been a wonderful experience for us.
Yeah. In your presentation this morning, which was entitled Mania, Manipulation and Meltdown, I'd like to talk a little bit about that. What was the major theme that you explained to the audience?
Well, the mania part was the NASDAQ mania, when things were trading at ridiculous values and you knew that you had to go into a bear market. The manipulation part was all those things that governments now do to try to prevent the normal flow of a bear market. And you know, a lot of us would have thought to ourselves, surely to goodness we can't have a zero interest rate policy in the developed world. Surely to goodness we're not going to print money. Surely to goodness we can't run deficits of $1.5 trillion every year before finally someone says it's not going to work. So all of those things I kind of put into the category of manipulation, and where things are never allowed to really go bankrupt, where it always gets taken over, so there's never a liquidity event, so that the financial markets never experience that Lehman moment again when they, you know, literally almost closed the banking business down, where we're within hours of closing it. So it's this always coming to the rescue and never allowing what should naturally play out. I describe that as manipulation. And then the meltdown part would be, you know, what ultimately happens? Do we just keep printing money? Do we keep relying on central banks? Do we keep relying on governments to develop stimulus programs and have increasing debt? Or do we someday have to face the music? And the music it will result in a meltdown, one way or the other. If we come up with austerity, we'll get shrinking GDP, as we experience in Greece. Once GDP went down, of course, the bond rates, the interest rates went through the roof, which put them in a death spiral. And we may see that in other countries as these rates start going up into double digits, and there's more demands for austerity. The more austerity, the more the deficit goes up, and the more the interest rates go up. So I don't know how we get out of it. I don't think we get out of it by having austerity. I think, you know, we'll just bring on the difficulties faster, and I think therefore they've opted to print money, and let's just see if we can extend and pretend and keep it going and hope that things become normal. But ultimately that would probably lead to some form of hyperinflation.
So printing money is obviously not the solution then?
Well, I think most careful people are very aware that printing money debases currencies and makes things that are real more valuable denominated in the currency. And that's why you and I are so involved in gold and silver and trying to suggest to people that there's not an easy way out here, and that in either scenario, gold and silver seems to be the obvious place to invest your money.
Yeah. When you talk about meltdown, you're talking about another Lehman event or something worse?
Well, no, what I think of is, I think of something worse. I think of people losing confidence in the banking system and in governments, because a lot of the banking problems have been transferred to governments now. And of course, the government would be translated by interest rates going to very high percentages, which of course would create bigger deficits than we already have. And finally, someone will throw up their hand and say, we just can't deal with this, and there'll be some kind of financial collapse. And my ultimate expectation is that people will realize that having money in banks is a risky proposition for no return. You get paid nothing to have your money there. Why do you take that risk? If you had money in Dexia and the governments hadn't come in to bail you out, you as a depositor would have lost money. And it's not worth getting 0.1% a year or half of 1% a year to take that kind of risk. And as people gradually come to that determination, I think the money will come out of banks and go into precious metals.
Well, that's an important point, because I think people already understand the inflation risk, but what you're basically suggesting is that people are only now starting to come to grips with the counterparty risk.
Sure. And of course, we've seen it manifested. We've seen examples of companies who've, I don't know if they've announced it, but it's become public information that they've taken their money out of the banks. And I think thinking people realize that there's a risk element because, of course, of all the counterparties, things that you've talked about for a long, long time. And, you know, once this thing gets ahead of steam and everyone's trying to put it with the top bank, all the lower level banks, of course, lose their deposits. They have to sell something. Well, as it turns out, there's nothing to sell. I mean, you want to sell a stock and it's down 25%. You want to sell a European government bond and it's down 10%. And of course, they don't want to throw up these losses on their income statement because it'll become more apparent that the capital's at risk. So they're in a precarious position where normally they have to fall back on governments now to inject money into the banking system.
But that's the liquidity event that you spoke about in your presentation this morning, describing the Lehman collapse as
right.
But so you see this ultimately recurring?
It almost has to recur. And it's only a question of why does it recur? Does it recur because, you know, they actually go to austerity? Does it recur because people just lose confidence in financial instruments and paper money? And it looks now like the more likely thing is they're going to lose confidence in the banking system and paper money.
Well, it also recurs because of the point you made this morning about the leverage in the system. That, you know, there's, as you explained,
Yeah.
there's just too much leverage.
Yeah.
So
the average person doesn't appreciate the leverage, though. I mean, the average guy
or
in
the
the street,
danger of the leverage.
I don't know. He has no idea. I mean, yes, analysts would understand what the leverage is, but I don't think the average person would. What they would probably understand is if, for example, we had another Dexia soon, then people would start linking things together. Maybe we could say that MF Global was the same as Dexia. It's not really because it's an investment dealer, but you know, if you had another situation where all of a sudden some bank has to be taken over by governments, maybe people start connecting the dots and say, well, who's next? And you know, what's my risk of losing money in the banking system?
Mm-hmm. So in terms of the banking system, that's inherently what you called the fundamental flaw?
Sure.
The fact that it's just too highly leveraged?
Yeah, well, I mean, I pointed out, you know, in a 20-to-1 leverage, and I think, for example, banks in Europe are more than 20-to-1 leverage. If you have $1 of assets, you can only lose 5 cents before you have zero capital. And when, for example, on the typical Friday night in the US, when a bank goes down, they actually lose 30 cents in the dollar. So they're losing their capital 6 times over. I mean, what's the chances of not losing 5 cents in a $1 investment, no matter what you're in? Government bond, mortgage, investing in the stock market. I mean, that's almost a daily occurrence.
Particularly given the fact that prices were bid up so high in the previous boom that they reached levels that were just not sustainable, price levels that were not sustainable.
In many things, whether it's housing or various financial, the whole derivative thing that is so complicated. I mean, you know, the level of derivatives that aren't even on the balance sheet is staggering.
Yeah.
So even when you're looking at 20-to-1, you have no idea whether it's really 20-to-1 anyway.
Yeah.
It could be 50-to-1.
I'm not even getting to the derivatives. It's bad enough just looking at what's more or less visible in terms of the way the banks report numbers.
Totally.
Speaking of which, you know, when I first was trained as a banker back in the late 1960s, it was prudent to have a loan-to-deposit ratio of about 0.7, 0.75. So in other words, you had more deposits than you had loans.
Mm-hmm.
I don't know if you're aware of this, but in Europe now, the loan-to-deposit ratio is 1.2, which just goes to show how sensitive these guys are to funding needs, and it explains why these guys are so panicked, because the traditional funding sources, money market funds from the US and things of that nature, have been turned off.
Mm-hmm.
So in order to get from a 1.2 loan to deposit ratio to a 0.7 or even a 0.8, a lot of assets have to be sold. Now those assets are not going to be sold anywhere near their face value, which means that a lot of losses are going to be taken, and that's going to erode capital bases. So
And
I guess
there's no one to sell them to.
Yeah.
Because everyone's doing the same thing at the same time, right?
Yeah.
Banking systems throughout the world are too levered. So who's the ultimate buyer? I guess the government can be the ultimate buyer, which has already happened, right? In the sense that they'll buy your sovereign debt from you here in Europe. They'll let you sell sovereign debt, and the Treasury buys Treasury bonds. And that's been one thing that's happening, that the banks are able to at least sell the bonds because in essence, the regulator comes in to buy them.
Well, the banks can try to move the assets around to make them believe that make the market believe that those assets have disappeared, but they really haven't. And one of the things we're seeing on both sides of the Atlantic is not only the quantitative easing by the central bank, but the qualitative easing, in the sense that the central banks, by buying a lot of these assets, the Greek debt that isn't really worth anything, and now the worries about the Italian and the Spanish debt, the quality of the assets on the central bank of the ECB, and even the Federal Reserve did this with a lot of the mortgage paper that they've bought. This qualitative easing on the asset side is just as harmful as the quantitative easing on the liability side by increasing the quantity of money.
And of course, there's no accounting for that, right? Because who would even deem to question the Fed or the ECB, even though people like yourself and myself realize exactly what's going on? But obviously, the average guy in the street doesn't even think about it. They don't even look at banks, let alone the central bank. And so there's this almost license to be irresponsible, which of course, having been given the license, they've used the license. But there's no question that, as these central banks get involved in buying bonds, they're just losing money.
Yeah.
But there's no accounting for it.
Yeah. I wrote a monograph a few years ago explaining why central banking was the barbarous relic. And here's a good example of it, basically how they're destroying the currency. Because once you erode the currency and the currency's usefulness, you're ultimately destroying the economy. And when the economy is destroyed, then everybody's hurt. And I think that's probably the beauty of what the Bundesbank had, in the sense that it was politically independent, and they guarded that independence. But would you agree now that the ECB is very much a political animal?
Totally. Well, I certainly think it. When Mr. Draghi's been there for all of like 2 days and he immediately cuts the rate by 1/4 point, not that it makes any difference, but it's, acts as some kind of stimulus for the market for yet another day until we all figure out that that's not going to make much difference.
Well, it does make a difference in the sense that inflation is already over 3% in Europe, and that's above their target.
Yeah.
And I think the actual inflation rate is higher than what the stated inflation rate is.
Sure.
So that's just putting more inflationary pressure, and ultimately is going to debase the currency even further.
Absolutely. Well, we certainly agree on that. And even when I think of, the real rates, the more they're going more negative. And of course, negative real rates is very positive for precious metals, because how do you maintain your purchasing power?
Yeah. Well, is there any other alternative other than gold and silver in terms of where you want to keep your liquidity?
Not liquidity, no. There's things that maybe you can invest in and survive, such as, maybe productive farmland or farm chemicals.
But you're talking about investments now as opposed to liquidity.
That's not, I agree. And I recognize that in terms of liquidity, there is nothing else you can do.
So you're still a proponent for continuing to accumulate gold and silver?
Totally.
Let's talk a little bit about silver, because you had some specific points in this presentation this morning. You're basically concluding that the numbers don't add up. Do you want to explain that?
When I look at the supply-demand numbers from 05 to 10, we have an approximate 900 million ounce market of recycled and produced silver per year. And when I look at the changes in supply, which have increased a little, and when I look at the change in demand and supply from China, the change in demand and supply from India, the creation of ETFs in silver, which didn't exist in 05, I can come up with 380 million ounces of net change in a 900 million ounce market. And that includes the change in supply. So I keep thinking, how can we go from 05 to today, and I can identify by going to 6 sources, 380 million change. How do we keep supplying all this silver to the market? And I think it seems fairly obvious to me, and it even seems more obvious having come here and see the interest in silver. As I surveyed the various sellers of gold and silver here, my question was, well, how much are you selling in gold and silver on a dollar basis? What's the ratio of the two? And I was amazed to find out that they sell as many dollars of silver as they sell dollars of gold, which means they're selling 50 times more volume of silver than volume of gold. But silver is only produced about 11 times more than the ounces of gold per year, and only about 5.5 of those times are available for investment because half the silver has to go to industry. So how can we buy it at 50 to 1 when the availability is 5 to 1? It just doesn't compute that we can keep doing that. So I'm really optimistic that the price of silver someday will move away from the influence of the paper market. I think the paper market has had a very, very negative influence on silver price. And you know, the day that we finally can't buy that last ingot of silver, we will know that the gig is up for the paper sellers, and silver will go to the appropriate price. And I've always thought it should be 16 to 1 because historically it's traded at that ratio. I just met a young gentleman here who studied the history of Europe and the relationship of silver to gold, and he said the actual ratio was something like 5 to 6 to 1, which I'm not that much of a student of history, but I know that in recent history it's been 16 to 1. So at, for example, a $1,600 gold price, silver should be 100. At a $2,500 gold price, well, we'll see a very significantly higher silver price.
What's likely to end the physical versus paper war that seems to be going on? Is it going to be just eventually that people disbelieve the paper and the liquidity dries up and goes away, or will there always be people trying to speculate on the price?
Well, I think what would end it, in sort of my dream situation is, and I'd love it to be me, you go out to go and buy some silver bars and you don't get delivery. And that would just indicate that they can't make delivery, and it would end. Or if, for example, Samsung said they got to stop producing phones because they can't buy any silver, they're just not getting delivery.
Yeah.
Some event like that, where people finally saw through the ruse of the paper markets, where physically it's not forthcoming.
Yeah, and the paper and physical markets will just diverge. I suppose not unlike what happened back with the London gold pool with gold back in the 1960s. You essentially had two markets, an artificial one that central banks made believe where the gold price was, and then you had the free market price, which was trading at a much higher premium.
Right.
And yet the Federal Reserve still, as a remnant from the decisions back then, carries gold on its balance sheet at $42.22, which is obviously nowhere near realistic in terms of what the market values gold as.
I mean, I think that'll happen. I mean, the physical market's going to win overall someday.
Yeah.
It has to.
Yeah.
Because if there's a shortage, of course, and it becomes apparent to people, all those people who've been investing in silver will be reinvigorated because they realize there is a shortage of silver, just as certain people have projected there has to be.
Yeah.
And then, you know, you'll get more of an interest. And of course, I think the general interest in precious metals is growing anyway. I'll just look at what's happening at this conference. You know, the attendance is up 20%. I'm sure the buying is probably up, buying of metals is up 25%. And these are numbers that don't fit with production increases of 2 and 4% a year or 5% a year. It just can't continue to happen. So sooner or later, the physical buyers will win the day.
Yeah, I know you're a very patient investor or accumulator. When you see undervalued assets, you ride with it until it eventually becomes overvalued. But would you care to, give an indication of your intuitive feel as to, are we getting close to that day when paper and silver and physical silver, separate?
Well, we can't be far away. I mean, when I look at the data, and I'm more of a student of the physical supply demand than I am of, the debilitating effect of fiat currency. Even when is in the simple example of comparing 2010 to 2011 in gold, we had the IMF selling 400 tons last year, and central banks are estimated to buy 400 to 500 tons this year. So we have an 8 to 900 ton change in a 4,000 ton market that didn't grow.
Yeah.
I don't know how that happens when I read about everyone else is buying more gold. So there has to be a shortage, and I have to conclude that central banks are probably still leasing gold. And I always think someday they're just going to look in the cupboard and say, we got to stop doing this, which they've sort of said already, but I suspect they still are.
I've sort of sensed just from the way the market's been trading, that we've seen backwardation in the metals before. I sort of sense that there's a backwardation presently, and there was an interesting article in the Wall Street Journal yesterday where they were talking about the LIBOR rate really didn't truly reflect the underlying interest rate. So by implication, if the LIBOR rate is not the accurate rate, then the supposed contango in the precious metals is not accurate, and that the reality is that the precious metals are in backwardation, which to a certain extent we can see anyway, because Sprott Physical trades at a premium to the spot market, and you're very close to physical anyway, so there already is like a natural backwardation.
And it's the fact that the Physical Silver Trust trades at a premium of 18 to 22% is, to me, a validation. And quite frankly, if I was one of the guys short silver, I'd be buying the Sprott Physical Silver Trust, because at least I know I'm going to get the silver.
Yeah, it's at least there someday. Yeah.
Someday,
Let's turn a little bit. You made an interesting comment this morning. Your little book that you'd written, which was a collection of your articles over the past 10 years, and you mentioned one about Dead Man Walking, and then the recent version of that, it's not in the book, but I guess it's on your website, is Dead Governments Walking. Can you explain a little bit about that?
Well, I wrote this article in '07 called Seriality Check Dead Men Walking, which said where we predicted that the following companies would go broke: Fannie Mae, Freddie Mac, GM, and Citigroup. And essentially they went broke. Some went into conservatorship, some were helped out by the government, but for all intents and purposes, they were broke at the time. And about 18 months ago, we wrote Seriality Check 2, Dead Governments Walking. And it essentially focused on the US government, and it focused on the known liabilities as reported by the Department of the Treasury using generally accepted accounting principles. Here's what our liabilities would be if we were accounting for the payments that we promised to make to our citizens. And the number is something like 70, 80 trillion dollars. It changes all the time and goes up by 7 or 8 trillion a year, so I might be a couple of years out because I wrote that 2 years ago. But let's just use the number of 80 trillion. I mean, GDP is 15 trillion, and the government says he has obligations that they haven't recognized of $80 trillion. Well, how does, let's pretend it was a corporation with 15 trillion of revenue. How do you support 80 trillion of obligations? I mean, you're bankrupt. You have to break your promises. So, are the Social Security payments going to be made? Are the Medicare and Medicaid payments going to be made? Are the government-sponsored pension funds going to be funded as promised? All these obligations where they promise to stand behind something, but on a mathematical and an accounting basis, there's no possible way that they can do it. So I call that dead governments walking. And I guess the classic example today is the Greece situation, who made even more gargantuan promises, only to find out that we can't do this. And next thing you know, no, you can't retire at 42, you gotta work till this age, we can't pay you this, everything changed overnight, almost overnight.
So a lot of promises are gonna be broken by governments around the world?
Yeah, of course. A lot of promises can be broken by governments around the world. And of course, a lot of promises are going to be broken by pension plans around the world. Corporate pension plans where they can't get the return equal to what they assumed they were supposed to get. So whatever benefits they promise people, they're not going to generate the kind of return to pay those benefits.
Yeah. What's clear, from this discussion and other discussions we had in your presentation this morning, you still expect that this financial bust has a way to go before we eventually cleanse the system and start with something new.
Well, it's funny when you said it has a way to go. I mean, cleansing. How long does cleansing take? I mean, that's going to be a long, long process. I don't even know when it finally goes broke, let alone cleanse it. I mean, the broke part, if we all realize that, it's not going to make it, then to finally, regain our footing and clean out that debt, I have no idea, James. You're more of a student of history than I am. I don't know how long that process takes. I'd hate to think how long it takes.
Yeah, it's impossible to predict. And the thing that I always find so scary is, you can look at an individual country and see what happens when the currency collapses there. But when you're talking about the world's reserve currency, and in fact, basically all the currencies of the world now are backed by nothing except government promises. Mm-hmm. How do you, recreate a system, after everything collapses. And it's pretty scary.
It's a monumental chore to even think about it, and I don't know how that happens, and particularly when no one wants it to happen and no one wants to admit it should happen, and everyone goes every step of the way to try to prevent it from happening, which is really what's happening today. So,
do you think governments will still have a role to play in money and currency in the future, or should their role be removed from it?
Well,
in order to distinguish between politics and money, because I always contend they don't mix, just like oil and water don't mix.
Well, I mean, that's the fundamental problem, right? That governments aren't held financially accountable for their decisions because they're there for a short time period. And, while I'm in power, we're in a party. And I'll leave the problem for someone else. And of course, someone else comes in, he realizes the dimension of the party, the problem, but he still wants to party. And, they try all these programs to try to keep things together, but all the while, and I think everybody knows it, the fiscal and deficit situation is deteriorating. So,
yeah, I did a King World News interview not too long ago, and we were talking about kicking the can down the road, and I said it's no longer a can, it's a 2-ton boulder. And people are finally starting to recognize, that we're pretty close to, the point where reality has to come back into play.
We're at that point. I mean, I can't say when it's going to be. Who knows when it's going to be? But you can sort of sense as you feel, even in particularly Europe now, how every day there's something new that happens, and the bond markets don't look like they're cooperating with the ESF involvement. They just don't look like they're cooperating.
Yeah.
So, and the bond market, of course, will be the tip-off to a fundamental problem, because it's so much bigger than the stock market, and governments need the bond market. And the fact that, was it the ESFS that 2 days ago tried to issue $3 billion of bonds, and they pulled the bond offering. Well, where does $3 billion get you?
Yeah, and
if you can't raise $3 billion,
how are they going to raise $1 trillion that they say they need? It's really sort of silly. I mean, you had a very scary chart in your presentation this morning, CDS rates on the European
on the sovereign debt.
Yeah, which basically it's worse now than it was back in 2008.
Back in 2008, it wasn't a sovereign problem. For sure it's a sovereign problem now, because the sovereigns took on the problems of the banking business.
So they've made a bad decision, they've gone down the wrong road, they seem to be sticking to this bad decision, rather than recognizing, like a businessman would, hey, we made a bad decision, we have to cut our losses and go back in the right direction. But they seem to be heading in the wrong direction, which is more money printing, qualitative easing, quantitative easing.
But even a businessman, I suspect when a businessman knows he's bankrupt, he doesn't declare bankruptcy. Somebody forces him into bankruptcy.
That's a good point.
Somebody calls the loan, right? I don't think any government is going to declare a bankruptcy. Someone's going to call the loan somewhere along the line. In other words, they're not going to buy the bonds. And when they don't buy the bonds, it's over, because your creditor won't give you credit.
Well, the fact that they didn't buy the EFSF bonds, maybe that's sort of the beginning of the tip of the iceberg.
It's a bit of a statement. That's why, we have to be concerned about that. That it's fine to promise things, but if really nobody wants to buy the credit, how do you provide the money?
Yeah.
So, today we hear about the IMF is going to create 250 billion of SDRs. Now, I'm not a great student of SDRs. I'm not even sure what an SDR is, and I don't know how you create it. Maybe just write something on a piece of paper saying we're created 250 billion of SDRs and we all go party some more. But that's where they're just writing it with their own pen. If they ask someone else to write them the check, they know they can't get the check.
Yeah. I often say that 100 years from now, people will look back at this era the same way we look back at the Mississippi bubble and the South Sea bubble, and ask how could people have been so gullible and clearly misunderstood exactly what was going on. And I guess what we have to really do as individuals is just step back from everything you see on TV and read in the papers and think it through from a logical, common sense point of view. Balance sheets, cash flow, at the end of the day, that's what really counts.
Yeah. I even look at the zero interest rate policy, and I always say, 10 years from now, we're going to look back and say, what did we think we were doing? We're not paying the savers any money to save? Like, it's ridiculous. I don't know where these theories came from. And, if you asked anybody to look back at their Economics 101 book, There was never a zero interest rate policy. There was never quantitative easing. There was never TARP, TALF, conservatorships. I never knew what a conservatorship was before. Now we have some of the biggest ones in the world.
Well, you're raising a good point, because I think a lot of people don't even understand what capital is, or what capitalism for that matter, because what we're talking about today is people saying it's a crisis of capitalism, but reality is it's a crisis of socialism. And I keep going back to one of my favorite quotes from Margaret Thatcher. She said, the problem with socialism is you eventually run out of other people's money. And that's, isn't that, it describes clearly what governments are doing today. They've taxed as much as they can. They're continuing to tax with the risk of destroying the economy. If they destroy the economy, where are they going to get the money to fulfill their promises? So a lot of promises are going to be broken.
Yeah, and just think of, the banking sector is a big sector, and they're all trying to deleverage. Are they going to be buying more government bonds? They might be locked out of them. They want to shrink their balance sheets. Well, the easiest thing, of course, to sell is the government bond, because there's a bid from the central banks right now.
Yeah.
But when it comes time to reload, who's going to be the buyer?
Yeah, the ECB has expanded its balance sheet €1 trillion over the past couple of years.
Right.
And most of that is just, government bonds and, other types of quantitative easing programs.
Sure.
So, I think we've got some serious issues to deal with in terms of currency. And in that environment, I guess the message for the viewers of this video is continue to stay the course, continue to accumulate gold and silver.
One thing I would certainly say to people, and I don't mind saying that I own personally 80%, at least 80% of my money in precious metals. Even the money I run on what I believe to be a very prudent basis, I have 80% of that in precious metals. And it doesn't bother me, because I see all the things that are going on around me, and I just, it pains me that others have not participated in this 11-year bull market where gold has outperformed almost every currency by 500 or 600%. It's outperformed, the stocks have outperformed the stock market by 1,400%. And there's this great wealth redistribution going on where you have to be in precious metals. And, when I said, I don't mean 1 or 2% of your portfolio in precious metals. Do I have problems saying that I think people should have a majority of their portfolio in precious metals? No, I don't. That's what I do. So it seems very logical to me.
Yeah, I always make the case, the older you are, the more precious metals you want, because you want to be conservative. And a lot of people will question, well, how can you be conservative? But that really is the conservative strategy. So the older you are, the higher percentage you should have.
People regard it as risky, being in precious metals.
Well,
I don't regard it that way. I think it's the wise thing to do.
Yeah, I agree with you completely. Well, Eric, it's been a real pleasure. Thank you very much. I've been speaking with Eric Sprott, the founder and chairman of Sprott Asset Management in Toronto, Canada. Thank you, Eric.
Okay, James, my honor to be here.
Thanks.